If you want to be profitable trading market pullbacks, the best way to do is to catch a pullback. So in today's video, we will discuss trading the initial pullback in a new trend, and I will reveal my strategy for determining the optimal entry point. There are numerous strategies for trading the market that make use of the exponential moving average. However, trading with the trend is the most common way in which these EMAs are employed by traders. And the concept is very simple. As an example, consider two exponential moving averages with different periods. It is assumed that the market is on an uptrend when the lower period EMA crosses above the higher period EMA, and vice versa. If the lower period EMA crosses below the higher period EMA, the market is deemed to be in a downtrend. So a lot of beginner traders see the crossover as a signal to either go long or short on the market. They go long when the lower period EMA crosses over the higher one, and vice versa. You can see it in the chart that if you went long or short each time the EMAs crossed, you would be stopped out of your trades all the time. So instead of entering a trade when the EMAs cross, use it as a signal that an uptrend or downtrend is forming. So you might be wondering right now, how can I then use EMAs to enter a trade? The solution is to trade pullbacks. So what exactly are pullbacks and why would you want to trade them? As I mentioned previously, one of the most popular trading strategies when trading any market is to trade pullbacks during an uptrend or downtrend. Pullbacks are also commonly known as retracements, and in addition, one of the reasons they are so popular is that when the markets trend upward, they do not simply rise in a straight line. There is always a period of recovery before the trend may be continued. It's very similar to taking a long road trip and then stopping at the rest stops every now and then before continuing on the journey. When markets are in an uptrend, they do make high highs and low lows, which indicates that the market is gaining momentum, and those high lows are the pullbacks. And when the markets are in a downtrend, they do make lower lows and lower highs. And as you probably know, market always has these pullbacks when trending, and that's a great opportunity for the traders to get into the trade before the market resumes its trend. While there are many different forms of moving averages, the EMA and simple moving average are the two most widely utilized. So why do we want to trade pullbacks with EMA rather than SMA? I want to highlight that both moving averages can be used to trade pullbacks. However, here's why I love EMAs. So let's say if you would plot EMA and SMA on the chart, you will notice that EMA tends to stay closer to the price, and as a result, when trading pullbacks or retracements using exponential moving averages, they will tend to make that market appear as if they are bouncing off the EMAs. While the SMAs can be used to trade pullbacks, they are not that sticky as the exponential moving average, and therefore exponential moving averages would be the optimal for our trading strategy. Before I go any further, I just want to tell you that this strategy works on most time frames, but for today's session, I really wanted to demonstrate how to generate some quick profits by utilizing this strategy on a smaller time frames. So for this strategy, we are going to use the 20 and 50 exponential moving averages. And as always, you can follow me along on how to add it to your chart. All you have to do is simply press on indicator section and type EMA. That will be the moving average exponential, and all you have to do is basically double click on it because we will need two of them. So once you add them on the chart, they will come up with default settings, but you will have to change them. So you can simply click on the setting bar, go into input section and choose the length of 20, and the second one will be in the value of 50. So this time I made an extra effort to make these lines more visible because I know that some of my subscribers are watching me on their phones, which makes it harder to see those thin lines. So this time I made them thicker to be more visible for you guys. Now we want to enter long only when 20 EMA is higher than 50 EMA, and we want to enter short positions only when 20 EMA is lower than a 50 EMA. So first and foremost, Next, we want to check a higher time frame such as 1 hour to indicate the overall trend. And I would like to mention one key factor that you should bear in mind. Let's say you have a long trade open on a 50-minute time frame or even on a 5-minute time frame, but then it suddenly starts to slightly move in a different direction. So guys, please do not start panicking, because we know that your 1 hour chart and its trend are much stronger than the trend on 50-minute time frame or even on a 5. As a result, the trade is most likely in its push exhaustion cycle before continuing its move towards your direction. So once you have your trend in place, what you need to do next is to wait for the EMAs to cross over another one. And once the 20 EMA has crossed above the 50 EMA, we want to look for the first bounce of the 50 EMA. Don't worry if the market didn't bounce off the EMA and just went through it, then we want to wait until the bounce occurs before considering that the first bounce.
One eternity later.
So let's say you have been waiting and we have a nice bounce of the 50 EMA. From there, you would be looking for a second bounce to get into a long trade. It might sound confusing, but trust me, once you put this into the practice, everything will fall into place. So then we would enter at the closed candlestick. So in this case, at the closure of the bullish engulfing candle, we would place our stop loss below the low of the previous swing low. And of course, your risk to reward ratio depends on your account and whether you are following your money management. Sometimes I don't use any stop loss when it comes to scalping due to the fact that I'm constantly watching the market and I can instantly close up my trades. But having a stop loss, if you're unable to watch the market all the time, is the best decision you can make when it comes to trading. So what you're about to hear next is supposed to be a secret, but it's not gonna be secret anymore because I'm gonna share it. But I have found a great website that I want to share, especially if you're a beginner or you are even more advanced trader and you just need a little confirmation before your entry. What you can do on this is actually you type any currency pair you are planning to use. So for example, I have EUR/USD right now. What you can do is to have an overview of the currency pair, performance, whether the market is overbought or oversold, what's the actual trend for that currency pair, but it does say buy or sell over here. And what you can actually do is to choose the time frame, let's say from daily, 1 hourly to 4 hourly to 50-minute time frame, and you can see whether the market is bullish, bearish, or in neutral. This is such a great website to help you with that extra confirmation before you entering your trade. Of course, you cannot rely only on a website telling you whether the market is bearish or bullish or you don't know what to do. You must do your own analysis before you considering any confirmation from this website. Here is my trade and its profits using this strategy. So let me break down for you how I ended up trading this currency pair. First things first, as I mentioned previously, we have to go to a higher time frame, which in this scenario is 1 hour chart. And on 1 hour chart, we can see that we do have a nice resistance going on with the multiple rejections, and we also have a nice bullish trend which ended up breaking towards a downside. So all we have to do right now is to go on a smaller time frame such as 15 minutes. So back on a 50-minute time frame, as I said, what you're looking for is for a first bounce of the 50 EMA, which has occurred over here. And then we had the second bounce over here as well of the 50 EMA, and this is where I entered my trade short. So currently my profits running in around of $200 so far, which I'm quite happy about it because it's scalping, so you're kind of in and out of the market. But I believe that this trade will go even further down, so I will keep that running. So again, this bearish engulfing candle closed next to the 20 EMA, which also a good sign. Then we have another bearish engulfing candle actually bouncing off a nice area of a sensitivity. So if this candlestick will close as well as a bearish engulfing, I will definitely keep this trade running. So here is a little update, $360 into the profit, which I'm super happy about it. I mean, 20 and 50 EMAs in scalping are very good, especially if you know how to use them correctly. So here's a little update. I am on 50-minute time frame. I have AUD USD and my trade reached take profit 1, which is around 20 pips in the profit. So in this case, of course, if you want, you can move your stop loss to an entry or near it. So in this case, you will have a risk-free trade, and in this case, you will be able to maximize your pip gain. And here's the final update. I have $600 into the profit by only scalping with these simple indicators and the most simplest pullback strategy that I ever showed you in my YouTube channel. And if you enjoyed this video, make sure you watch this video next, because this one is pretty damn good.